So if you've been paying any attention to the markets over, what, the last 5 years, you have basically lived through the golden age of megacap growth.
Oh, absolutely. Whether you're talking about the AI trade, high-quality large caps,
Or just the concentration in the Magnificent Seven. That's where all the investor enthusiasm and, frankly, all the real alpha has been.
and if you were invested anywhere else, especially in the small cap sector,
You've been fighting an uphill
a
battle.
serious one. I mean, small cap stocks, which were, the traditional engine for that huge early stage growth,
Right.
they've spent half a decade delivering performances that are just profoundly disappointing.
And that context is so important because the prediction we found in our source material for today's deep dive is, well, it's nothing short of audacious.
It's a big call.
A very big call.
Yeah.
We're talking about a specific small cap value ETF, the Avantis U.S. small cap value ETF,
Yeah.
ticker AVUV.
Okay.
And some experts believe it is uniquely positioned to get 100% plus gains, potentially doubling its value over just the next 5 years.
That is a phenomenal prediction, especially when you look at the historical data, which shows such, tepid returns.
Exactly. Predicting a double takes extraordinary confidence.
In a very specific strategy, and it also assumes a major macroeconomic shift is coming.
A bold claim is absolutely an understatement. So if the sector has been averaging these low returns, what specific parts of AVUV's strategy and what conditions in the market have to go perfectly right for it to actually hit that triple-digit return?
That's the question.
That's our mission today, to dissect that strategy, that forecast, and figure out what makes this one fund so different.
Okay, so let's start by just setting the scene, the magnitude of the struggle.
Right. Why are small-cap investors so frustrated?
Well, when you look at the last 5 years, this whole asset class has been sort of structurally penalized by the macroeconomic environment.
Tell us why. What was it that crushed that traditional small-cap advantage?
It really comes down to two big factors: interest rates and liquidity. For a lot of the recent past, especially that pre-inflation period, we were in a near zero interest rate environment.
Right.
And that kind of environment just disproportionately benefits long-duration assets.
Meaning growth stocks.
Exactly. High-flying tech companies that promise big earnings way out in the future. Small cap value, which kind of relies on the here and now, economic stability, cyclical moves, it was just starved of capital.
So all the money rushed to that guaranteed growth story, and it left the smaller, often more volatile companies behind.
Precisely. And the data really confirms this. It's not just a feeling.
What do the numbers say?
If you look at the core small cap benchmarks over the past 5 years, they lag badly. The Russell 2000 index returned only about 38% over that whole period.
38%.
The S&P small cap 600, which is a little higher quality, did a bit better, maybe around 44%.
44% over 5 years is, it's decent.
Yeah.
But when the whole market story is about AI and these spectacular tech gains,
It feels like you're falling behind.
it really does.
Yeah.
Especially for an asset class that's named for explosive potential. So that really sets the baseline of struggle.
It does. It confirms that capital was just heavily favoring large, proven, liquid companies. It was not a friendly environment for smaller firms.
Okay, so now that we understand that very difficult backdrop, let's bring in the main character here.
The outlier.
The outlier. The Avantis U.S. Small Cap Value ETF, AVUV. Because this fund has not struggled.
It is the definition of an outperformer.
It certainly is.
Yeah.
And the fund itself is actually pretty young. It just turned 6 years old in September.
Right.
But its growth has been meteoric. It has already amassed nearly $19 billion in assets under management.
And that AUM number is really telling.
How so?
Because small cap investing hasn't been fashionable at all, yet AVUV has just exploded. It's already the 6th largest small cap ETF of any type.
Not just value, you're saying?
Not just value. That includes growth and blend funds, too. So both institutional and retail investors have been flocking to it.
Which signals they see something different happening here.
They do. And that difference is really visible in the returns.
So while the S&P Small Cap 600 Index was getting that 44% return, our source material points out that AVUV sharply outperformed it by what they called a country mile.
A great way to put it.
Specifically, AVUV actually flirted with achieving a double over those same 5 years.
Just think about that for a second. It generated returns closer to what you might expect from a high-flying growth stock.
In a value sector that was supposed to be completely dormant.
And it did this during the peak of enthusiasm for megacap growth. during this intense demand for high-quality, large-cap stocks.
Okay, so that is the core puzzle we have to solve.
Right.
How do you get growth stock performance from a struggling value sector?
This is where their specific investment strategy comes into play.
And why it's so different from just a passive index fund?
It's where it gets really interesting because the secret, it seems, lies in active management combined with really rigorous screening.
So AVUV is an actively managed fund.
It is, which immediately gives it an edge in the small cap space.
Okay, but most of the investing world now believes passive is superior, it's cheaper, it prevents manager error. So why is active management suddenly a good thing with small companies?
It's purely an issue of information asymmetry.
Meaning?
Well, if you look at a large cap stock, say the top 50 names in the S&P 500, they might have dozens of sell-side analysts covering them.
Parsing every bit of news, their prices are very efficient.
Exactly. It's hard for a manager to get an edge because everyone already knows everything.
Right.
But small cap stocks are often thinly covered or not covered at all by analysts.
So there's an opportunity.
A huge one. It creates fertile ground for skilled, active managers to go in and unearth these hidden gems that the rest of the market is just ignoring or fundamentally mispricing. The market is inefficient here.
And the team behind AVUV has a track record of exploiting that.
A proven one.
Okay, so active management lets them find stocks that are cheaper than the market realizes. But that doesn't save you from the classic value trap, does it?
No, it doesn't.
Stock that looks cheap, but it's cheap for a very good reason, like it has collapsing margins or some terminal problem.
And this is the second, and I'd say the most critical pillar of their strategy, the quality filter.
Okay.
They avoid that trap by actively checking these quality boxes. AVUV's strategy isn't just about low price to book or low PE
A
ratios.
typical value metric.
Right. They insist on finding smaller stocks that also possess higher profitability ratios and overall financial health.
Okay, let's unpack that. Because doesn't the S&P Small Cap 600 Value Index already have profitability mandates, like return on equity or ROE?
It does.
So why is AVUV's filter so much better?
That's a great question, and it really highlights the nuance. Indexes often apply these relatively light static screens.
Like just making sure a company has positive earnings.
Exactly. Positive ROE or positive earnings. AVUV goes much, much deeper. They prioritize sustainable, high-quality metrics. Things like high return on invested capital.
ROIC.
Right. And sustained high free cash flow yields, solid balance sheets.
So they aren't just looking for a single positive earnings number.
No.
They're looking for real evidence that the company is a good steward of its capital and actually generates cash.
Precisely. It's the difference between a stock that's cheap because it had one good quarter versus a stock that's cheap despite having a 5-year track record of superior capital management.
I see.
By focusing on that profitability and robust cash flow, they systematically filter out all the companies with weak fundamentals.
Which are the very companies that tend to drag down the passive indexes during times of stress.
That's exactly why they outperform those indexes so significantly, even during the toughest times.
So it's almost like they're creating a new subcategory here, not just small cap value, but small cap high quality value.
That's a very accurate way to put it.
Taking some of that classic volatility out of the equation by just removing the low quality risks.
And that's why the fund's success really isn't luck. It's a strategy designed to perform in all environments, but especially when the market finally starts rewarding quality again.
Okay, so we've established the track record, we've established the rigorous strategy. Now let's pivot to the really big claim.
Forecast.
The forecast. That prediction of 100% plus gains over the next 5 years.
Right.
To get those kinds of triple-digit returns, the macroeconomic environment has to shift from being an enemy to a friend.
That's right. The whole bullish outlook relies on the necessary alignment of stars,
Which means,
primarily an earnest rotation of capital back into this sector.
so what needs to happen on the monetary policy side? Does the Fed have to start cutting rates dramatically for small caps to take off?
Not necessarily dramatically, but you need stability and predictability.
Okay.
Small cap performance is highly sensitive to the economic cycle. So what they really need is, say, moderate rate cuts combined with a soft landing scenario.
A belief that the economy is stable, not overheating.
Exactly. When interest rates normalize and come down a bit, the cost of capital for these smaller, often more indebted companies goes down. That's a direct tailwind.
And what about investor behavior? Where does all that rotational capital come from?
It comes from the rebalancing phenomenon. Like we said, for years, portfolios have become intensely concentrated in megacap growth.
That trade has gotten very crowded.
Very crowded. And now investors are looking for two things: diversification and exposure to sectors that haven't already had this massive multiple expansion.
And small cap value fits that description perfectly. It's the unloved asset class.
It is. So when these large institutional funds begin to rotate even a tiny percentage of their capital out of big tech and into small cap value,
The impact on valuations is disproportionate.
huge. These smaller companies just require less capital flow to see a significant movement in their price.
So the 100% gain forecast requires two things to happen at once.
Yeah.
You need earnings growth, driven by better economic conditions and lower rates, plus that significant multiple expansion as capital finally flows back in.
That is precisely the required confluence of events. And the key to hitting that triple-digit number really is the multiple expansion.
Why that specific?
Because right now, small cap value stocks are trading at historically deep discounts compared to large caps.
Okay.
So if investors realize that AVUV is capturing the absolute highest quality stocks within that discounted universe, the inflows could cause PE ratios to just surge.
And that would provide the bulk of that 100% return.
It would.
But let's play skeptic for a moment. If the economy hits a sharp recession, that forecast is out the window.
Oh, absolutely. The prediction is highly conditional on that soft landing scenario.
But
But even if volatility continues, AVUV is positioned better than its peers because of that quality screen.
right.
In a recession, low-quality, unprofitable companies are the first to fail. AVUV, having already filtered them out, is structurally more resilient.
So the 100% target might not be met, but it would likely still outperform.
It's just a higher conviction bet on the eventual recovery.
So for you, the learner, taking this deep dive into our source material really gives some critical insight into this idea of a renaissance for small cap value,
It does.
and especially the mechanics behind the optimism for AVUV.
First, you have the historical proof of concept.
Right.
AVUV nearly doubled its value when its benchmarks were severely lagging. That just demonstrates the power of its strategy in bad conditions.
Second, the crucial strategic advantage,
Mm-hmm.
active management combined with that vital filter of high profitability.
Quality metrics like superior cash flow.
A strategy that is specifically designed to bypass those common value traps that just sink passive funds.
And third, there's the forward-looking economic context,
The anticipated macroeconomic rotation.
where institutional investors are looking to diversify away from those crowded growth portfolios. And that capital shift is really poised to deliver the multiple expansion needed to potentially hit that 100% gain.
This whole discussion really just underscores the benefits of, hiring smart managers when you're playing in an inefficient, complex part of the market.
Especially one that lacks broad analyst coverage.
Right. If the market isn't doing the work for you, a highly disciplined management team can create tremendous value.
It highlights that not all value is created equal.
Which brings us to the final provocative thought for you to consider as you wrap up this deep dive.
Okay.
When a fund like AVUV intentionally focuses on filtering for pure quality demanding high profitability ratios, robust capital management, how fundamentally does that change the perceived risk profile of investing in small cap value?
That's a great question.
If you strip out all the lowest quality companies, are you still truly engaging in the same high-risk trade that the index represents? Or have you actually created a new, maybe less volatile asset class altogether? It's a fascinating question about how active screening can reframe both risk and reward.